Hello, everybody. Good evening and welcome. I'm Sergey Guriev, Dean of the school. I'm very happy to welcome you to this event organized together by Wheeler Institute for Business and Development and AQR Institute for Asset Management. This is the best representation of what LBS is when we bring together academics and practitioners to talk about new ideas. And this is a new book by Patrick and Haizhou, which really puts forward something that people have not thought about before. Now, sometimes it takes a lot of time to write the book. So if you go back to 2017, when the first paper was published, that already generated a lot of debate about those ideas in the book. I should say that I've been looking forward to reading the book for many years. And I was one of the first readers of the book because the publisher sent it to me in hard copy. I was not your referee, I was not your reporter, but I was reporting on some other book, and publishers told me, which books for free would you like to get from us as a token of gratitude for your wonderful referee report on another book? And I said, this is the book which is coming up, right? So I would like to avoid paying £13 and get it for free. This is a wonderful book, well worth whatever, $13.50 you can spend on it. It literally puts forward a new big idea, which doesn't happen every year, believe me. Many of the things the authors are going to talk about today are established conventional wisdoms dating back decades, and in some cases actually more than a century. And in that sense, challenging the conventional wisdom is what academics usually are supposed to do. Whenever we publish a new paper, we pretend to overturn the wisdom, break the frontier, but in reality, it's very rare when the books like this come out. I should say that when talking before the lecture today, Patrick mentioned how he used to present with all technological transparencies. I was one of the students. I know Patrick for almost 30 years when Patrick was using transparencies to give a summer school on contract theory. At that point, that was 1996. At that point, Patrick said, look forward to our textbook, which is coming up soon. At that point, it took 7 years again. So it's a cycle. It's the cycle. So the book came out in 2004. And since then, my takeaway is it's always worth looking forward to Patrick's books. I highly recommend this book, and I'm looking forward to this exciting event. Please listen carefully and prepare your questions. There will be 20 minutes in the end for questions and answers. And there'll be also a book signing ceremony right after this event, just outside the room. Welcome, and thank you very much for coming in such great numbers. Thank you.
Okay, so I've been asked to introduce the authors briefly and the book, and that's a pleasure for me to do. And if you don't mind, Haizhou, I'll start with Patrick because I have known him for a little longer, in fact, since 1978. Patrick has always been interested by ideas in every area of economics. In 1978, he was always talking about, reading the classics, discussing those ideas, not restricted to any one field. And it's really quite shocking that most economists, especially in my field, finance, have an education that doesn't cover the classics at all. They've simply haven't read, or maybe haven't even heard of many of them. But Keynes, Wicksell, Hayek, Marshall, Bagehot, these are the people that formed part of Patrick's education. He's read them, as we all should, and Patrick doesn't read them just as a hobby, a nerdy hobby to explore history of economic thought, but as a useful tool, a crucial tool for the foundation of the work of an economist. Patrick's CV is very distinguished. He's known for his work on contract theory, especially financial contracting. He has a PhD textbook that Sergey referred to with Mathias Duatripon. He has papers on capitalism versus central planning, real options, environmental, climate change. He's past president of the American Finance Association. Now, prior to my meeting with Patrick, he was brought up running around with the children and goats of a small village in the East Engadine Valley in eastern Switzerland. So he probably wasn't interested in economics at that time. His tie with the Alps has remained, and there's a small village in a little valley in Savoie which has, at one end of it, Patrick's chalet. And at the other end, it has my chalet. And there are always many guests at Patrick's house, always interesting to talk about ideas. Often they're economists, but not always. One evening, the guest there was Haizhou, together with his charming family. And we have an interesting and convivial evening. Plans to reconnect were put on hold by the arrival of COVID 2 months later. So recently, I was wondering, I wonder what happened to Haizhou. And then, a few days later, I found out, because I was asked to come along to this event. Haizhou was a lecturer at the LSE in the early 90s, where he met Patrick, and then worked for some years at the IMF, which Patrick also visited. Subsequently, Haizhou moved into the private sector and was chief China analyst at Barclays in Hong Kong, and then joined China's leading investment bank, CICC, where he was head of equities with all the responsibilities and activities that you can imagine. And that includes, for example, IPOs such as Ag Bank of China, which was at the time the world's largest IPO, 22 billion in 2010. Haizhou recently retired from CICC and was appointed, however, to the Monetary Policy Committee of the People's Bank of China, China's central bank. He is also a professor at PBOC School of Finance in Tsinghua University and at SAFE at Shanghai University, Shanghai Jiaotong University. Okay, so those are the authors. Briefly, the book. I'll let them talk about the book because obviously they're better qualified. But I'll just mention that I'm a microeconomist, and I think it's brave for Patrick, a microeconomist, to go into macroeconomist, because that's a very difficult transition. And they're looking at, in this book, at the big question, monetarism and monetary policy. Macro always seems very unnatural to me, because in micro we look at small questions with maximum logic, and the questions rapidly become too big in macro. I once had to read a paper on helicopter money, which was about the following question. If a helicopter's flying by throwing money down onto people, which demographic subgroups would you like to target who are most likely to re-spend the money on someone else? And I found that very weird. I asked a colleague, actually it was Hélène, I asked Hélène, why is that the objective, to just re-spend the money right away? Surely it matters what you spend the money on. You know, if I'm a drug addict and I spend it on drugs, is that good? If I'm addicted to credit and I spend it on stuff I can't afford, does my consumer surplus matter? Anyway, I was made to understand that I should stay in my lane and that macro was not really for me. Now, this book uses a very important tool, which is insights from corporate finance, microeconomics, to look at monetary policy. We often hear about dilution in finance, meaning, something bad. Equity holders suffer from dilution. I always teach my students that that's overly simplified. It matters what the money is spent on and how it's issued. In the analogy pursued in the book, increasing the money supply is like raising equity. And just as I said with dilution, they emphasize that while creating money can be inflationary, this is not so if it's spent on the right thing. It depends very much what it's spent on. They use common sense textbook ideas from corporate finance, in particular ideas about capital structure, debt overhang, frictions, Modigliani-Miller, and so on, to analyze a range of subjects in macroeconomics, such as foreign exchange reserve management, lender of last resort, bailouts, crises. They also provide narratives of China's economic development and, more generally, financial development in the past 30 years. I should probably stop. Characteristically, I'll just say the book is grounded in insights from the classics. It goes straight in to the original article by Friedman and Schwartz on monetary policy, and Hyman Minsky's critique of it, and uses that to talk about the issues very elegantly. So I'll turn over to Patrick and Haizhou to present their analysis. Afterwards, Richard Portis will lead a conversation. Anna Pavlova is going to wrap up. Patrick and Haizhou will be on the stand out there, outside the room, by the elevators, to sign copies of the book. Thank you.
So, why don't you just go for it? Go for it.
Let me see. So, first of all, Sergey, James, thank you for this wonderful introduction. It's really a great pleasure to be here with old friends and to be able to talk about our new book and hopefully, get some of you interested in reading it. So, I think you may have gathered from the earlier comments that we're trying to do, at the minimum, something different. Whether this is good or bad, that will be for you to judge, but hopefully at least you will come away thinking, yes, this is something different, this is something we haven't heard before. The core idea of the book, as James mentioned, is that you can think of fiat money the same way as you can think of equity for a company. That's the core idea. It's an imperfect analogy, but I think it's always productive to do analogies, see how far they go, where the limits are, you learn something from it. So definitely it is an imperfect analogy. You might wonder, how did we ever come up with this idea? How did we think of making that connection? It's certainly not a connection that was there before in monetary economics. And a little anecdote, that was the result of a conversation in a taxi in Beijing, in Tiananmen Square. We were stuck in traffic. And we were talking about contingent convertible bonds. And we were wondering, does it make sense for a sovereign to issue contingent convertible bonds? Can you think of sovereign contingent convertible bonds? And then the next question was, okay, what does the bond convert into? What's the analogy of money? What's the analogy of equity for a sovereign? And then it hit on us. Money is equity of a nation, and that's how it got started. So what you'll see in the book, as James mentioned, we start out by doing a critique of monetarism, because of course, if monetarism is all without any flaws, there's not much to be added. But you will quickly see that there are major flaws in monetarism, and the flaws, if I can summarize, they have to do with a lack of emphasis, a lack of understanding of how money should be supplied. So it's much more, monetarism is much more about demand for money. It's much less about supply of money. In fact, the simple-minded monetarism is you just want to have a fixed rule for a supply of money, and that's the best you can do. And preferably, the fixed rule should be you shrink the money supply. That's the Friedman rule, right? And then the best you can do is to shrink the money supply. No matter, you don't ask the question, where's the money supply coming from in the first place? You just say, well, whatever money supply we have, you shrink it until it disappears. So it's not a good theory of supply of money. Okay, so then if you're interested in supply of money, where do you look for principles? And there it makes a lot of sense to look at corporate finance, because corporate finance has been studying and thinking for decades the question of when does it make sense for a corporation to issue equity? When does it not make sense? How do you think about that? And James mentioned earlier that there's this concept, a fundamental concept in corporate finance, dilution costs. Idea being you issue more shares. A lot of people think in practice you're diluting our ownership, the owners of the current shareholders. If you issue more shares, you dilute their ownership. Okay? Well, that's a simple-minded first analysis. Whether you dilute or not depends on whether you issue new shares at the fair price. If you issue new shares at the fair price, there is no dilution. Whatever money you raise grows the pie in the same proportion. Nobody is diluted, okay? But obviously, equity isn't always issued at the fair price. There's generally dilution. And then what's the analogy with money? Dilution can be thought of when you think about monetary economics in terms of inflation. It's the same idea as inflation. And think about inflation, cost of inflation. If you double the quantity of money and you double prices, there are no costs if everybody gets the same increase in money balances. They just get to buy the same things. It's just that the price is a bit higher, but they get their purchasing power isn't affected. People worry about inflation when there are transfers, when there is redistribution. Okay, so that's what we're doing in the book. That's these are some of the ideas we push. One last word, and then I want to let Haizhou speak. James alluded to Bagehot and the lender of last resort. So 2 years ago, the Nobel Prize in Economics was awarded to Diamond, Dybvig, and Bernanke. And the award for Diamond and Dybvig was for their joint article, Diamond Dybvig on the Theory of Banking. Okay, so we are taking our ideas, them, if you want, as a starting point. And those of you who are familiar with that article and have read it, you will immediately notice there's no money in their model. It's a real economy model. There is no money. And then if there is no money, the next question is, well, how does the lender of last resort work? Where does the lender of last resort get the resources to bail out banks that are subject to a run? Okay, that's a big hole in the analysis. Now, if you have a monetary economy, there's infinite supply of money. Central bank can always print money, and now you can talk about lender of last resort. But once you have a monetary economy, how you think about lender of last resort is different. You have to think about effects on price level, et cetera, et cetera. I don't want to give too much away, and I tend to speak a bit too long, so I want to leave Haizhou to thank you.
Thanks again for hosting us. And Richard, I think I will look forward. For me, personally, I benefit for many years, actually, a few decades, your advice, and Elaine, we were at ASE, and Elaine also provide one of the endorsement for the book. So hopefully that's going to increase the sales book by 10 times. So that's it. So I guess that probably we don't have time to use slides. Maybe I use a couple of slides. The idea started with Patrick gave a talk at SAFE, which managed at that time about $3 trillion reserve. Convertible bond, and then, of course, the idea is COCO converted to what? To equity. I think that's we realize that equity of a nation is very important, which is money. By the way, I changed my department name at the CICC to Equities Department. CICC didn't have equity department. I realized equity is so beautiful, and everything is about equity. And So my department actually contributed for 70% of profit of the firm. So equity is vitally important. Patrick mentioned about the dilution cost, which is really, really important. If we think about in corporate world, through IPO or through seasonal offer, and actually additional money raised after the IPO can increase the share value. We know that very well. And in corporate world, of course, if we think about the Magnificent Seven, the giant technology companies in the US, virtually all of them keep issue new equities. Virtually none of them had much debt. So if you think about the capital structure of those corporations, it's very much against the conventional wisdom in corporate finance. Well, for corporations like Microsoft, in rating is so good, it's better than US sovereign. And for tax purpose, Microsoft should issue huge amount of debt. But Microsoft never issue much debt. There's very little debt on the balance sheet over the years. So whenever they find opportunities, they issue new equity, finance a new project, and actually the share price goes up all the time. So I think that's really, really intriguing. To borrow that insight, to think about the capital structure of nations, of course, we think about the equity money issued by central bank, and also the sovereign bond issued in domestic currency as part of the equity. The debt, in our capital structure of nations structure, is really the foreign debt. Okay, say Argentina borrowed in US dollar. So I think that's really form the foundation for our analysis. James already mentioned this is related to Modigliani Miller, and actually is also related to a lot of debates in monetary economics. For example, Friedman versus Hayek. So when Friedman think about the monetary policy in domestic context, his thought was within the Modigliani Miller framework, although he didn't probably realize, he never acknowledged that. When Friedman conducted the debate with Hayek about whether only the national central bank should issue currency, or Hayek argued that there is a denationalization of currencies, anyone can issue currencies, Hayek stayed in the Modigliani Miller framework. Friedman stayed away from Modigliani Miller framework. So actually, we discussed that. So in a way, it's all tied together. And of course, you really think about the perfect capital markets, Modigliani Miller framework, then Ricardo equivalence, neutrality of money, everything is pretty much stay in that kind of framework. So in a way that the micro foundation we built, James talked about that, I think it helps us to understand other ideas in monetary economics and monetary policy, and also connect all those ideas in a coherent way. So I think it's much easier to understand for us. The second thing we tried is I think that we write a model on money banking and central banking. I think that's we want to share some of that in this evening. Patrick already mentioned the Dam-Dewey model. There is no money there. Because there is no money there, you cannot talk about central banking. And of course, here, Bank of England was the first central bank created here. And then, of course, when we talk about the financial crisis or banking crisis, we always refer to so-called the budget rule. That's Lombard Street. Budget rule rely on very much debt intervention. The central bank only lend to sovereign but illiquid banks against good collateral and at a penalty rate. That in natural, that's what the budget rule is talking about. If we really think about what the Federal Reserve did in 2008 and 2009 crisis, or let's say 2020 in the COVID crisis, of course, the Federal Reserve deviated massively from the budget rule. The Federal Reserve provide rescue to banks, Citibank, investment banks, Goldman, Morgan Stanley, that were not regulated by the Fed. AIG, entirely outside the Fed regulation. Fannie Mae, Freddie Mae. Okay, that's of course that the Federal Reserve provided rescue to all financial institutions in trouble after the Lehman collapse. The Federal Reserve did not demand for collateral. The Federal Reserve did not charge a penalty rate. So it's completely against the budget rule. What the Fed did, of course, is equity intervention. The Fed provided capital injection swap for equity of those firms. So Fed owned, 20% of Goldman, Morgan Stanley. Fed owned 87% of AIG. The Fed owned certain percentage of Fannie Mae, Freddie Mac, so on and so forth. When the Federal Reserve started to do those kind of policy, to push this kind of policy, it was widely criticized by the Chicago School. There was actually an open letter signed by many, leading economists, Lucas and Farmer and so on and so forth. Criticize the Fed, say that you are against the, of course, the Badger rule, which is the rule we all understand and we agree on. And you are risking with the taxpayers' money, and if that, is very likely you are going to fail. In the end, of course, that in all the rescue that the Federal Reserve did during the crisis, there was no single case of failure. Federal Reserve made money on every case, and the Federal Reserve turned $1 trillion profit to the U.S. Treasury. I think that's something we really need to understand. So in our model with money banking and central banking, it's not about a debt swap, it's about an equity intervention. So in a crisis time, there is huge deflation. Okay, so in a way that you need to stabilize the asset price, you need to stabilize the price level for the whole economy. In this case, what would be the cost of printing money, i.e., issue new equity? That could generate a dilution cost of inflation, but the inflation in this case is a good thing. It's not really a bad thing, right? And also in the financial crisis, none of other financial institutions can issue equity easily at the market price. The only institution that has the capability is the central bank. So central bank in this case can issue equity, do all kind of equity swap, then rescue all those kind of institutions, make a profit out there. Why? When prices stabilize, the economy get out of deflation, and then all the investment projects become profitable, and very likely. And that's basically, so we actually show in our model, there is a central bank will stand in any cases, not suffer any financial losses. I mean, in that kind. So I think that provocative idea, I think that we can discuss it. We probably hear Wiseman from Richard. China did that in the 1990s. Okay, when China started its market reform in the 1990s, remember that all the banks were insolvent. Why? Because all the borrowers, SOEs, were insolvent. So that's the situation in transition, is right. So in the 80s, of course, banks gave grant to SOEs. SOEs, pay all the dividend, whatever. Not so much. It's not a market operation. All of a sudden, the SOEs will need to, pay tax and then pay interest on the loan, and so the whole economy, they state-owned enterprise, they're all in huge debt and unprofitable, and the banks were in serious trouble. What the PBOC did, and we provide analysis actually on China. We try to answer one important question: how China finances its growth. So in the finance world, of course, the magnitude of finance, that the money that need to be raised in China to finance such a large economy over the last 40 years of rapid growth, the magnitude is more or less like a total amount of financing needed in Europe over 200 years, over 200-year history. But China did that over a very short period of time, pretty much like in 25 years, because all the financing started to kick off in the 1990s. So there, of course, that other developing countries, say Latin America, rely on foreign debt, in terms of structure or capital structure, and they got into huge trouble. And when Patrick and I present our idea at the IMF, that question was asked: why the Latin America couldn't replicate the kind of succeed? One simple answer from all course that Latin America got the capital structure wrong, capital structure of nations. They rely too much on foreign debt. So I think that if possible, the developing countries should also try to issue as much domestic currency, i.e., as much equity as possible. So what China did, of course, that China, the central bank created a financing company called Huijin, and that provided the needed capital injection to all the banks, trouble banks, all the state-owned banks. Then, of course, they invite foreign banks, Citi, HSBC, Deutsche Bank, all the European banks, American banks, to become partner of those banks, okay, clean up the balance sheet, create a good bank, bad bank model. And then, of course, all the Chinese banks start to learn the modern banking management skills. And then they were successfully listed in Hong Kong Stock Exchange first, or they sold to international investors. And then they really provide all this kind of lending to domestic enterprises. So, of course, PBOC also behind all this. And if you look at China's money growth, so-called M2 growth, over the last 40 years, the M2 growth is very high. There was a lot of criticism in China even, and also in international economics contact about the PBOC print too much money. I mean, we disagree with that. By the way, I'm a member of the Monetary Policy Committee. I'm not speaking on behalf of PBOC tonight. So the reason is that China did not really suffer high inflation over the last 40 years. But China financed all this, railway, port, urbanization, industrialization through PBOC print enough money, finance the domestic investment. And I think that's the key. The other side of the coin, or another related question, is that if China, the PBOC had not printed so much money, what would be the growth rate in China in the last 40 years? Arguably be much lower. So for many central banks, or for many countries, there are two interesting questions that we should look at. The current central banking, in a way, orthodox, I would say, inflation targeting, for example, focus too much narrowly on, hit inflation target. And that actually could lead to this risk of underfinancing our economy, suffering low growth rate. I think that's very important. And if an economy is stuck in deflation, like Japan or like China before September this year, I think that to maintain financial stability in that kind of environment, i.e., prolonged deflation, is very risky, is dangerous. So I think in that sense, inflation targeting is narrowly defined inflation targeting. We think that it means something very important. It means the opportunity for growth. It could mean this, financial stability. I think that's a very important point I want to highlight. I think that on China, of course, that more recently, I think that China suffered deflation. I think that in September, the last week of September, China started to push for a new round of policy. I think that we supported that policy. I would say I supported that policy inside PBOC. I think that's the right policy to go. And related to that, I think our book, 2 minutes, I think is something I think Richard would not let me go without saying that, which is the optimal currency area. And so if we think about the currency is the equity of a nation, when should two countries jointly issue one currency, i.e. two nations join a monetary union? Of course, there is an excellent theory by Bob Mundell, which pretty much rely on transaction costs. Say that when the transaction costs, exchange rate, all that, if you can get rid of that, and of course that is useful. I think that transaction costs, of course, nowadays is very low, maybe zero. So in a way, use that as a justification for Euro project wouldn't be so useful. But Euro, I think there is good foundation. So we find a new foundation in that chapter. Basically, that when two countries each issue its own currency, of course that they can take advantage by issuing a little more currency to buy more goods from the other country. So in a way that there is externality in this two country exchange reward. So by forming a single currency, of course, you remove that cost. That cost is inflationary. Okay, but what do you give up? What you give up the right or the option value in a crisis time, you can print money to rescue your own financial system. I think that's the trade-off. Another way to say that, I think that is that the Mundell model rely on transaction costs. Our model rely on contract theory, a la Hartmore and Patrick Bolton. I think that's the way probably to read it. Yeah. In nutshell, what we do is we incorporate insight, deep insights or conventional wisdom from corporate finance to monetary theory, monetary economics. To do this right, we need to employ contract theory. Patrick is, so in a way, the whole book, everything is about the contract theory, inside out. But I think for all the readers, if you are not so familiar with the contract theory, I think you can still read the book. I think without the contract. Thank you so much.
Am I now audible? Microphone on? Yes, I think it is. I'm delighted to be here with two old friends, and delighted that Haizhou's been in the sort of macro monetary game for quite a while in his way. But Patrick, I love this conversion. I think it's terrific. And I'm a little bit disappointed in you because neither of you has actually made any publicity for the book. There it is, right? There are copies outside, and I highly recommend that you. I highly recommend that you get it. So, my job is to put some questions. I know some of the answers, I think, but I'm not going to betray those, and I'm going to try to focus on some of the themes of this book, which is so wide-ranging that it's clearly impossible for us to cover that range in the few minutes that are available. But let me start with the basic proposition of the corporate equity fiat money analogy and the capital structure story, and ask, where's debt in this story? And in particular, I'm thinking both of national debt and of private sector debt. And there I get to leverage and the leverage cycle. Some of the macroeconomic issues that you raise, to me as a macroeconomist and somebody who's very involved with macroprudential policy at the moment, I think about the leverage cycle a lot. Okay, so how does that relate to, in particular, to your regime of money and banking dominance? One of you start on that?
Go first.
If we think about the capital structure of nations, money issued by central bank, and also the sovereign bond issued by treasury denominated in domestic currency, this is regarded as equity, and the foreign debt is the debt of our nation. That's our definition. In terms of the domestic leverage, that's a very important question. We have a chapter on money banking and central banking. So in a way that the central bank print money, we call it as outside money. Mm-hmm. And the credit, that is created by the banking system is inside money. Inside money is far bigger, the amount is far bigger than outside money because they can leverage up, 8 times more or less, yeah. So here, inside money, of course, is a creation based on outside money, which is domestic equity. So there is a central bank money was a commercial bank credit in our model. That's why we can talk about the money banking and the rescue of last resort. So that is not left out. That is very important. Related to that, of course, in China, of course, when M2 increased by central bank, the credit increase is far bigger than M2. That is basically the inside money created by the banking system.
Yeah, can I add one other thing? I think the leverage cycle, the way we address it is in terms of coordination of fiscal and monetary policy. And this is a very mature field, mature subject. So, we're trying to add new points, new observations. So it's not in terms of trying to necessarily say that what has been analyzed so far is not right. It may well be right? But what we are adding is this idea that this is really, we hit on this by accident, by just looking, we thought, let's do a historical review of China and the US in terms of fiscal and monetary coordination. And then we discovered that both China and the US had long cycles. These are long cycles. These are not business cycles. These are more like over 10, 15, 20 years.
40 years, roughly.
Or 40 years.
About 40 years.
Of fiscal dominance, then followed by monetary dominance, or what we call monetary and banking dominance, and so on and so forth. And so we were really struck by that. There are these long swings, one dominance, then you switch to other dominance. We were wondering what causes the switch? Why would you go from fiscal dominance to monetary and banking dominance and vice versa, monetary and banking dominance to fiscal dominance? Well, fiscal dominance, it sort of runs its course when you run out of fiscal space. So then you have a fiscal crisis, you can't use the fiscal arm much anymore for macro purposes. Then you're pushed into a money banking macro vehicle, and then that can push you in a money banking dominance regime. And then what causes that regime to end? Generally, a financial crisis. So that's why we want to call this as money and banking dominance, because if you only have money, you don't have financial crisis. You can't explain how money dominance ever ends. So the idea that you have to have money and banking is really critical. That's a critical part of the framing.
But fiscal dominance, in your sense, in your story, has nothing to do with the fiscal theory of the price level, does it?
Not as far as I know.
Okay. Just checking. Don't want to get you into that game, right? Right. Yeah, I was intrigued by the phrase or the sentence that the value of fiat money depends on the strength of the issuer. How would you define strength? Is it debt to GDP ratio? Is it growth prospects? What is it that determines this value of fiat money?
That's a great question. Haizhou, you go first.
I think that if we think about a corporation, say that issue new equity, or in some cases like Magnificent Seven, the share price continue to go up because they invest the money for successful projects. Those projects' return is far more than whatever the money raised is, right? The new equity raised. So that's one scenario. And there are other scenarios where the new equity is issued, and the investment become not so successful, and that's of course the share value will come down. That's in our case is they create a dilution cost. So basically, that using the same analogy, of course, that if a country has a better growth perspective, and that better growth perspective should be financed by adequate equity issuance. That's the idea.
Yeah, and I mean maybe related to that, somewhat different, slightly different angle to your question. So, if you're taking a monetarist perspective, well, it's all how you link the price level with the quantity of money, yeah. But you're not asking what's the underlying output that you're getting by using the money or spending the money, right? And that can change. That's where the strength of the issuer is, and so it's sort of a very striking example is we briefly described the episode of how you had during the Civil War in the U.S. you had two currencies competing with each other. You had the grayback and the greenback. Okay. Now the grayback, the greenback, and inflation was driven partly by how much relative money supply you would have in the north and the south, But it was also driven by whether you were successful on the battlefield. Whenever one side lost a battle, the value of its currency went down. So that's an easier way of understanding the.
Yes, I hope.
It's extreme, of course, but
maybe I add a little here. So in our book, we in very simple way, we say money is sovereignty. So the strength, of course, is the strength of sovereignty. So in a crisis, in a war crisis, of course, if the sovereignty can win the war, that's really the key. If the sovereignty can win the war, currency value will stabilize, can even increase. If the sovereignty lost the war, everything would collapse to zero. So the greenback, of course, issued by the South, collapsed to zero after the end of the Civil War. And also that if you think about in other countries' case, say in China, 1945, 1949, Civil War in China, Kuomintang lost the war. The conventional wisdom is that Kuomintang issued a lot of money. But had Kuomintang win the war, will the Kuomintang money be stabilized? Of course. Will the value go up? Yes. The money issued by communists will collapse. I think that's the strength of sovereignty.
Of course, Germany suffered a major hyperinflation after the Second World War, and with a lag after the First World War. So that's an example for you. I want to get on to the Bagehot rule in a minute, but let me just stick, and I want to get on to China in a minute. But there's just too many questions that arise from this book. But let me ask something that will interest a number of people here. Your view about central bank balance sheets now. Have they really become too big? Is that process of QE, has that led us to danger areas for the central banks? And must they really cut back? In your perspective, what's the optimal size of the central bank's balance sheet?
Great question. I mean, I keep asking myself this question. I teach a financial crisis and regulatory responses course at Columbia with Jeff Gordon, and of course we do cover the great financial crisis, and then the Fed response, the growth of the balance sheet of the Fed, and then there are all these recent questions, tapering, should you taper or not, what's the right size? My take on all this is nobody knows.
Okay, fair enough. Good, nope, I buy that. Right? Okay, I'll pass to the next question. An easier question, maybe. No, it's not really. And it's about crises, and the Bagehot rule and all that. And I, of course, agree that you can't deal with systemic insolvency with the Bagehot rule. You can't assess the solvency of an individual bank in a financial crisis where the system is going down. But in my view, anyway, the central bank can't rescue an insolvent banking system without a fiscal backup. Mm-hmm. And I'd like you to like to know whether you would agree with this. I mean, in practice, that fiscal intervention may be direct. I'm a UK taxpayer. I still own a piece of Lloyds Bank and of NatWest, which absorbed Royal Bank of Scotland. Right? And I'm waiting for my return on this, but it hasn't come yet. But there was your debt equity swap directly, okay, and indeed the American examples fit that. But what's the role of the fiscal authority then in your view?
So in our framework on that question, there is no fiscal authority. There's no fiscal arm of the government. And so, what is the lender of last resort achieving? I think it's related to your question. So, in essence, it's all about achieving efficient resolution. So you start out with you understand your banking system, for whatever reason, is insolvent. someone messed up, something bad happened, non-performing loans are bigger than the equity in the bank. The bank is insolvent. Now, whenever you have an insolvency, the question is, do you liquidate or do you reorganize? That's the question for non-financial firms. But it's the same question for banks. Do you close down the bank, i.e. liquidate, or do you reorganize the bank? Now, the reorganization, that's a recapitalization. How you recapitalize? Well, you buy out the non-performing loans, and you can buy those out by printing money. You recapitalize the bank, and if the bank is on a continuation basis solvent, then it's worth doing. That's the point. I mean, if I can put it that way, I mean, that's the point.
Let me just turn, we ought to allow space for questions from this audience and possibly from those online. But let me ask at least one question about China. I've got lots of questions about China, but let me ask one, which is in the data that you show, and data that's actually familiar to me from another context, there's this rising share of bonds in financing Chinese growth in recent years. Why is that? And how does it relate to the central themes of the book?
Okay, yeah. The rise now of bond, China has several bond market in a way. They're a little segregated. The largest bond market is the interbank bond market. That's regulated by PBOC and is friendly to market. And I think that's the most important market. The second bond, corporate bond, the issuance for corporate to issue bond, they will need to get approval from National Development and Reform Committee, NDRC, and various Director General of Finance Department at the NDRC, virtually all of them end up in prison, because it's very hard to get approval, and there is a lot of corruption involved with that. So that bond market is not so developed. And then in terms of trading, of course, the interbank trading and the interbank market, and then there is the stock exchange also leads the bond trading. So in case of the bond issuance, the majority in terms of volume is issued through the interbank market to help corporation to manage their liquidity, and also that to help the banks in a way to better manage their balance sheet. Because in case of China, that when the bank take 100 yuan deposit, a commercial bank, the bank can only lend out about 65 yuan out of the 100 deposit. And there is, of course, there is a capital adequacy requirement, there is a liquidity, all that, but still there is a sizable amount of idle liquidity running at the banking system. So in a way that corporates in China, they have problem to borrow loans to manage the liquidity, but they can fairly easily issue short-term bond in the interbank market to manage the liquidity, and that also help banks, commercial banks, to manage the balance sheet. So I think that's the main reason.
Okay. All right, I have lots more questions here, but I think I'm not going to be selfish, and I'm going to turn to the audience to ask whether people have issues they want to raise. I see Lucrezia Reichlin there, and could someone give her a microphone, please?
Well, thank you. This is very intriguing. I haven't read the book, so maybe my question is completely outside what you say. But I wonder, why do you have to be so radical? I mean, in a way, a macroeconomist would think that money is debt for the public sector. It's not equity, it's debt. It's in the liability side of the balance sheet. And unless you believe in monetary neutrality, and a lot of macroeconomists don't these days, if you use this debt in a good way, then you would increase productivity and inflation will go down rather than up. So that's very traditional macro. You don't need corporate finance for that. So how would you react to?
So I think it's important to frame money as equity and not debt. I think that's important. I think you can get into a corner muddled if you think of money as debt. You know, we spend a fair amount of time, right, thinking about this, and the analogy works surprisingly well. But what your other point, which is that about the non-neutrality of money, or about some other frictions that lead to underemployed resources and macro policies that can help you get back to better employed resources or full employment and so on. Absolutely right. You're absolutely right. And you know, we are not trying to be radical here. We are trying to offer an analytical framework that maybe gives you another angle at addressing some of these macro questions, a helpful angle. And I think in terms of big picture things, the really most productive framing comes when you look at the macro experience of China. 4 decades or 2.5 decades of very high growth. If you look at a macro textbook, international macro, it should never have happened, because macro is all based on the idea that you can only develop through foreign direct investment, and China had very little foreign direct investment. And understanding how the capex, the astronomical capex that China had, which of course it was an underdeveloped economy, it was a poor economy, a lot of efficiency gains that could happen. It was underfinanced, had financial constraints. But understanding that you can relax those financial constraints by issuing equity, by using money, and you make it possible to fund productive capex, raises output, you don't have inflation, and you can keep going. You have a growth engine. That's one particular, example where taking the equity interpretation is very helpful.
Maybe I add a little footnote here. Patrick and I had a few very interesting discussions with a senior central banker in China. His name is Chen Yuan. He was a senior deputy governor at the PBOC. Later on, he became the chairman of China Development Bank. His father was running the China's central planning economy for 4 decades. His father was only number 2 to then, so he lived until 1990s. So of course, that the whole doctrine is money is debt. That money is debt that the central bank issued to the society. So we had this conversation with Chen Yuan, and of course he said, this is debt. Why you call this equity? It cannot be equity. So of course we joked with him a little, say, what kind of debt is this? 0 coupon, infinite maturity, but when the PBOC issued this renminbi, can the holder of renminbi go to central bank and say, I want to buy rice? I mean, what kind of backing is that? If it's 0 coupon, infinite maturity, without any obligation to pay you anything in goods, that's equity. And he got it, and he said that he agreed. I mean, he said otherwise it's so convoluted to say this is a 0 coupon, infinite maturity. I mean, no real obligation by the issuer. What is that? Yeah, just a footnote. Yeah.
I saw another question over there before. That's the gentleman with his hand up here. Will you give him the mic, please?
This is Ted. I'm a government economist of the UK HM Treasury, and I would like to raise the question regarding the property market or real estate market. How does that affect money and the banking sector? Thank you.
In China or in general?
Well, China is a part of the global economy, but I guess you can give me 2 different views if you see US market versus the Chinese market.
In our framework, Richard asked a very important question. The banking system creates the inside money, of course, by granting loan to borrowers. Who are the borrowers? Corporates. In case of China, over the last 30 years, 40 years, urbanization is the major driver to the growth. So they lend a lot to property developers and also to mortgage takers. So really, if you think about the credit growth, much of the credit growth came from the property sector in China. And behind that is M2 growth, rapid M2 growth, M2 growth provided by the central bank. That's the point. So of course here, the key question is that from commercial bank's perspective, whether the investment is profitable, i.e. the project has positive NPV. If we think about the capitalization from nationwide perspective, again, it's the same. If the central bank issue outside money, that is multiplied, leveraged out by commercial banks as inside money that's a credit to the society. Whether that credit will indeed generate positive return, i.e. the credit can be paid back. As long as that is good, I mean the property sector is a very important driver for the growth. In case of China, of course, urbanization is indeed a key driver for China's growth for the last 40 years.
So I've got two more questions that I've seen. One is the gentleman there who had his hand up before. Are there any questions, by the way, from the web? Okay, we'll have those in a minute. Just a moment. Go ahead.
Thank you. Very insightful. So my question is also about China. So in your theory, how do you think of China's current sovereign capital structure, and what's your solution to China's deflation and how to improve China's economy? Thank you.
Since the last week of September, as I said, that the Chinese government started to implement a stimulus package to stabilize the growth, to deal with the deflation. Patrick and I actually just published an op-ed in Project Syndicate, talk about whether China will be able to get out of the deflation trap in a way. Of course, that this is a very early stage. I think that in terms of policy direction, is welcome and is positive direction. Whether this is going to be successful, of course, they need other policies, including fiscal, including reform, of course. So in a very nutshell, any kind of policy, any kind of money printing, if it can lead to positive NPV project financing, that's good. If it doesn't, of course, that's going to generate problem, inflation or other kind of problems, financial instability.
Yeah, but also I think your question refers to the fact that when you look at China, it has very little foreign currency sovereign debt that it has issued, right? That's the sense in which, how I understood your question. And then the question, well, is that the right thing? Should China issue more foreign currency debt or not? How do we think about the money supply and the exchange rate, the renminbi exchange rate with the other currencies? So that's a much less well understood question than the question of capital structure for a corporation. Now, what we point out in the book is that typically advanced countries, think of the US, UK, European Union, Switzerland, China,
Japan, even.
Japan, they don't issue foreign currency denominated debt. Typically, they don't issue. So this is what I would, one analogy you might think is, well, maybe they're a bit like the Magnificent Seven, right? They don't issue any debt either. But that's somewhat speculative. Would it be in their interest at some point to issue a lot of foreign currency debt? Maybe, but so far they haven't.
Okay, we do have some questions from the audience online. Try to keep them brief.
I will try.
Yeah.
So we have a question from Jerome, who has asked, I have one question regarding inflation. Is inflation still a good way to measure economy, since the most growth in industrialized countries is based on rising value of real estate? Quant inflation does not reflect it. I can repeat the question.
The question is about inflation
Yes.
in the recent experience, or
It's just asking whether it's a good way to measure economy, since most growth is in industrialized countries.
whether it's measured correctly. You mean?
I assume that is what they mean. The question is online.
Yeah,
If you don't,
not sure I have an answer to this.
then don't try.
I can ask a follow-up question
okay,
if I'm allowed.
all right.
Can I?
Yeah.
So regarding, I guess, developing economies, which you briefly touched earlier when you were talking, what are the key financial strategies that developing economies can adapt to abstract investment and drive growth, kind of based on what you've talked about in your book?
Okay, so the key chapter in the book on money and growth is the chapter on China, which really illustrates how money supply can and a fairly permissive money supply, as Haizhou pointed out earlier. Even in China, it was considered to be too permissive. But how a fairly permissive money supply policy can unleash growth or higher growth. China is a good example of that. Now, the broader lessons are that emerging market countries today, middle-income countries, poor countries looking to develop, maybe for them studying what China has done on the monetary policy front may be more helpful, more relevant than simply adopting a monetary policy that's suitable for an advanced country, but not necessarily suitable for a country that is looking to grow. So, and then you look around, you ask, well, what do we say? What do we have to say about monetary policy in poor or middle-income countries? Very little, very little. So the whole literature is about monetary policies of advanced countries, and those are not the same. Those are not the same problems.
Maybe I add a footnote here again.
Just a footnote. We're running out of time.
Yeah. So we look at the U.S. experience very closely. And it's quite amazing, at least to us, that the U.S. M2 growth after the Great Depression, during the Second World War, and after 2008, 2009 crisis, and after 2020, is truly astonishing. During the Second World War, U.S. GDP growth at 20% per annum or even higher. Guess what would be the U.S. M2 growth during the Second World War? M2 growth reached 50% per annum, 30%, 50%. I think that all the monetary economists didn't. I never seen anyone talk about that. So U.S. finances growth during the Second World War very rapid, because the largest economy. I mean, actually by 1945, 50% of world GDP through domestic money printing, and that's something that we should not forget. How did the U.S. get out of the Great Depression? Of course, there is a New Deal, all kind of policies, social policy, but the Fed printed money like mad. Okay, that's something we should not forget. And basically that 2008, 2009, I already mentioned about that. And then think about the COVID experience. Before April, the U.S. April 2020, the U.S. government didn't do anything. Since April, the U.S. government, Federal Reserve and the Treasury, Federal Reserve probably is not the government, Federal Reserve and the Treasury. So over a 6-month period from April to October, the Federal Reserve expanded its balance sheet by over $4 trillion US. That's bigger than the 3 QEs combined. That 3 QE took 6 years. And what is the M2 growth? M2 growth in the US, again, reached over 30% per annum. And of course, the fiscal deficit in 12 months period, $6 trillion US. That's way, way above the 3% GDP, actually almost 30% of GDP for the year, over 20% of GDP. In 2012, Larry Summers gave a very important speech at the IMF, worried about the US would be facing secular stagnation at that time. I mean, Europe was facing problem, the debt crisis. So I met Larry Summers 2 weeks ago at Harvard. He organized something. So I asked him whether the US will be facing secular stagnation in the near future. He said, all the problems addressed. I said, how? Well, we print a lot of money. So advanced economy also print a lot of money. Compared to the US, many countries in Europe, continental Europe, are too conservative. They should learn from the US. I'm Chinese, I'm not saying they learn from China.
I'm afraid just one footnote, and that is, of course, the US had very comprehensive price controls during the Second World War.
Exactly,
and
for sure.
That sort of helped.
Yeah.
But I'm afraid, I know there are other questions, in particular James Dow had a question, but it'll have to be dealt with offline, as it were. And I'm going to hand over to Anna, our colleague, Anna Pavlova, Professor of Finance at London Business School, who will make some closing remarks.
Hello, everybody. Well, thank you so much, Patrick Haizhou, for this, and Richard, of course, for this really exciting and stimulating evening. So it is not very often that you hear a truly innovative idea, and this is what we heard today. In fact, the first time I heard about this idea was at the American Finance Association presidential address that Patrick was giving to a room of 400, 500 financial economists, and people were scratching their heads back then. Nobody's scratching their heads now, because I think you have managed to convince the profession that money can really be thought of as equity. Nobody has ever made this remark before, never made this connection before. And this incredibly unique connection between corporate finance that all of us have been teaching forever and monetary economics that seemed so distant and disconnected, now they are back together, and through this idea that money is equity. And many of us have been observing these experiences of developed world, the US, printing money after the global financial crisis, and year after year, we've been getting questions from our students then, when are we going to see inflation? Isn't printing money bad that we are going to get inflation? And no, year after year, this inflation didn't keep materializing. And similar questions about China. So why isn't there inflation in China with all the printing? And in fact, what we have is this incredible growth. And I think now we have a theory that truly links this together and explains it in an incredibly elegant and convincing way that we have never thought of. And it's so nice to have this book now that lays it out nice and clear for us to contemplate and build on. And I hope that there is follow-up to this book, and so we learn more about monetary policy. So I think what the book is this big idea about linking money and equity. So the next thing is the new monetary policy, that it should not be inflation targeting or whatever else is being targeted, but it should be about these positive NPV projects that we heard about. And exactly how do we identify this positive NPV project, and what should be kind of the more concrete guidelines for the monetary policy. So I think we are ready for your second book now about the new monetary policy with the idea of money being equity of the nation. So let me not keep you here anymore. I think we all would like to get our books signed. And this signing is going to be happening right here, right outside the lecture theater. So please queue up. And this would be an opportunity to ask some questions offline and, of course, get the signatures of the distinguished authors of the book. So thank you very much for coming to this event. And so I appreciate you being here.